Kelly, it's been there's no other way to describe it. It's been a really tough start to the year. January was one of the worst total return months that we've seen in the muni bond market. But with that, in our view, comes opportunity. The market has really reset itself in a significant way, and we think investors should definitely be thinking about deploying capital. We certainly are at Neuberger Berman right now.
Yeah, for some context, I think they dropped, 2.5%. So given the declines a lot of people are experiencing in the stock market, that doesn't sound so bad right now. But why has the asset class been under pressure?
The good news is this is coming from the right reasons. What you don't want to see the muni market sell off because of a credit reason or a liquidity reason. Those are not the problems we're dealing with right now. What you have is, as you said, Kelly, people are expecting the Fed to raise rates. Treasury rates have been moving higher, and that has led to an outflow cycle in muni mutual funds. But this reset has really made valuations attractive. Just this week, the state of California is in the market with a large GO deal. This is a very high quality credit. They've had huge surpluses in recent years, and you can buy those bonds in 10 years at a yield around 2%. That's pre-tax. That's better than the yield on the U.S. Treasury. That is a really, really good deal for tax-paying investors in our view. We're looking at that deal and we're getting involved.
Yeah, and when you're buying sort of munis for, let's say, a 10-year horizon, I don't know how long people typically hold them, but we are going to see more rate volatility this year. It could mean munis underperform again for periods of time. Do you still think that people should pocket a pretty decent total return?
I think they will. Predicting rates is a very, very difficult thing. I think when you get, in my experience, when you get backups like this, you start putting money to work. And we talk to clients all the time, Kelly. We advise them, think about muni bond allocations as a long-term allocation, not a trade. And remember, you're in it for preservation of capital and tax efficiency. If you own really good bonds, you're going to get to a really good destination in this asset class.
The elephant in the room here is inflation. And I wonder, for a lot of people who are really concerned about keeping up with inflation, which tomorrow morning could be in the 8% range, if even getting, let's call it a 3, 4, 5% after-tax return isn't good enough for them, what would you say to people who are just saying, I don't know why I need to hang on to an asset that's going to underperform inflation?
I think you have to invest in munis right now with a framework. And so first of all, keep the assets short, 10 years and in, have a lot of bonds due in 1 to 5 years. So if the scenario that you described, Kelly, plays out where rates keep moving higher, you have a lot of bonds coming due that you can redeploy back into the market. The other thing, Kelly, in these uncertain times, focus on quality. You are getting a competitive return right now on high quality munis, unlike 2021, where you had to go way down in quality to get a halfway decent yield. So play it safe, keep it short. And I think if investors do that, they can get a competitive return, even if inflation is more persistent than we all want.
Great points. Jamie, thanks so much. Appreciate you having you on today.
Shepard Smith here. Thanks for watching CNBC on YouTube.